Cheers, Curious Minds crew. Hope you guys have had a good holiday season. Yes, I've been a little MIA. Holidays, the year kicked off in full gear with year end stuff and all of that. Last week I had given a little talk to some of the agents I work with, and we were talking about just property and casualty insurance trends, national kind of macro stuff, and then more specifically California. And is what I want to kind of go through, and I'll try to be quick about this, but I kind of want to lay out just a couple of things that when you look at the numbers and the stats and the trends that to me indicate that we are past what I'm calling peak pain and we're coming down the other side. So we'll go through a few things over the next few minutes, and hopefully it'll be some interesting information. Okay, so my little image on the screen, you can see I'm trying to use my little nano banana from Google Gemini to kind of illustrate, we're all going along, 2020 hits, COVID hits, we have massive global shutdown, supply chains shut down, that supply shock driven inflation just in short order just drives the cost of many, many, many things like through the roof, right? And then the insurance companies, obviously we have a kind of a lagging timeline. They had to catch up, get their rate to risk exposures back in line. So we had this just crazy cycle through COVID and then post-COVID. And so I kind of look at this as a 5 to 8 year, COVID, post-COVID journey, meaning the black swan hit, the market, everybody reacted. We had 2023, 2024, a lot of rate increases, both nationally and here in California, get put into the system to try to play that catch up and close that gap between what the costs of claims were and what the rates were being charged, and kind of trying to get that back in line. And so over the last few years, as the companies have tightened underwriting, changed the profiles of their books of business, gotten rate increases, some of that supply shock driven inflation, that stuff's kind of now behind us in most cases. And even though inflation is a little bit stickier and a little higher than we experienced before COVID, we've been in a trend line here for a little bit. So what it seems to be happening is those rates that got into the system 2022, 23, and 24, mostly 2023 and 24, and then parts of last year, that has improved the profitability picture for the P&C carriers. And now we're just starting to see glimmers in California of insurance companies starting to talk about the G word, growing again. Now, not across all segments, not across all lines. Auto is starting to heat up as far as some companies wanting to start write business again. Admitted property is starting to come around a tiny bit. So again, that's kind of the quick backstory on the trend. So let's look at a few actual stats. Now, the 2025 full year numbers are not available for the national trends yet, and won't be available for a while from the California department. So we'll have to kind of wait and see how that shakes out. Okay, but let's look really quickly at some of the trends, and I'm gonna highlight a couple of quick things here that I think are relevant. And when you look here, this is from the NAIC, and these are national total property and casualty for the U.S., as you can see here, U.S. You can see that during COVID in 2020, everything shut down and nobody was going anywhere. Profitability got really, really good. But then came the massive problems, the supply shock driven inflation, and the rates just did not catch up. So you see that in 2020, the loss ratios nationally went from 59, we'll call it 60%, to 62, popped up to 67, which when you're talking $1 trillion of premium is a massive amount of incurred loss, right? Claims. So then we start to see in 2022, 2023, and 2024, a lot of the rate increases, right? And a lot of the underwriting and a lot of the capacity constraints, a lot of the actions that were really difficult for consumers and business owners and agents and the carriers who are actually paying the claims to have to navigate through. But you started to see this going from a 67 to a 65, and then in 2024, a 61, almost 62%. Now, when you look at 2025, these numbers are not apples for apples. Okay, so we can see though that in 2024, the industry was just over $1 trillion of premium. So a trillion 29 billion. If we just straight annualized through June, we're looking about 1.2 trillion, right? So some solid, significant growth in the industry, and profitability is still holding on. So it'll be interesting to see where we land, because the LA wildfires happened in January of last year. Those losses, are included here, and of course, still a lot of outstanding claims, and that the total loss picture for LA fires is still emerging. So it'll be interesting to see kind of where the 2025 national and then California results land from a profitability perspective. But that was another serious black swan that hurt so many people. Okay, so that's kind of national. Now, what's interesting is this shows you the premium and growth trends. And what's interesting is the little dotted line is growth. You can see that, we had kind of a slowdown in growth, which you would assume would happen in 2020. And then with that kind of drip inflation, and I'm going to show a chart of that in just a second, just to kind of help us visualize the timing of kind of the cost drivers and then the rate catching up. This all kind of started right to pick back up, and in post 2020, and so you see this premium growth each year, right? This is almost 10%, almost 10%, a little over 10%, and then why I feel like we are past peak pain. Look at the growth percentage starts to drop. Now, again, it'd be interesting to see what happens in 2025. I suspect that we're going to be slightly lower or about the same as 2024. Now, I'm not an economist. I'm not an actuary. I don't know really anything. I'm just an insurance dude that's observing the trends. But it seems to me, based on everything I've been seeing and absorbing, that last year was similar to slightly lower rate increase in growth environment than last year, 2024. So, but you can see premium trends kind of steadily climb. So, as you look at the aggregate GDP and aggregate asset and liability base countrywide, right?